All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market here this morning, down about 10 points, not really doing a heck of a whole lot. Pretty much where it was Wednesday and where it spent the day Wednesday. And really the market since the close on Tuesday just hasn't gone anywhere. It has been a very kind of lackluster in terms of movement relative to what December and the beginning of January was. It just kind of feels like a big exhale out of the market right here, and just kind of we see analyst action really taking hold, and we see movement on that. But outside of that, a lot of things are just kind of taking a little bit of a breather. We're seeing option values really compress, very nicely, and so it's nice to see there. But overall, we're getting up towards this kind of resistance area we talked about, this kind of retest area we talked about, and for my money, we're there, right? I mean, the area is large enough that we're there. It doesn't mean we have to go up to this level. We could move a little higher and then something, but we could even break above these levels, right? We could see the market break above these levels and then have a little correction. But one of the things that we talked about in December happening in the market is there was some forced selling. Fund managers were forced to sell. They may not have wanted to sell their GM, or maybe they thought, AT&T, it's a great company, great stock, good stuff going on, but they have to sell. There's a forced selling element because, boom, all of the market is tanking. There's big reds on the screen, and there's just this kind of forced hand element of getting out. Also, redemptions, for funds and hedge funds, start to come in, and so there's this element of forced selling that comes in, and money managers have to get on out. Well, one of the things that could start to happen here is we could see the opposite start to take place in forced entries. This is kind of a nightmare start to January for a lot of fund managers. Why? Well, their performance is measured relative to the indexes, right? When you're a fund manager, you are kind of beholden to the indexes. You can be up 10% for the year, and if the market's up 30%, that looks horrid. You could be up 10% for the year, and if the market is down 10% for the year, you are a genius. You can make 10%, and you are gauged whether you're a genius or an idiot based on what the market did. When we come and we look at the performance, right, and we just take a look, I'm just going to come in here to the performance, just to a quick performance chart, and we come into year-to-date. Here on the S&P, year-to-date on the S&P is 3.2% higher. IWM, well, it's not quite keeping up, right? I mean, it's up 6 point. Sorry, I was looking at the wrong number. It's like, that looks funny. It's up 6.8%, right? Huge gain there on the IWM to start the year. Here's the Qs. They're up 4%. So if you're a fund manager, right? If you're a fund manager and you're light on cash or you're light on positions and heavy on cash into the end of last year, and you see this rally, and you know what, your fund is up a little bit. It's up 1.5–2%. You're sitting there in the red. You might be in the green, but you're actually sitting in the red. You're in a position where you are trailing the market. And when the market goes on some big rips early months, that's what we tend to see is fund managers are trailing the market. We don't have that data yet, but given past history, I suspect it's very similar. And so it puts fund managers in an awkward position because they can wait. And they can say, you know what, I'm going to wait. I want to wait for earnings. I want to wait for this. I want to wait for that. I want to see what this looks like and that looks like. And you know what? The market's up another 5% on them. Then what? Can you imagine being that fund manager, being in that position? Where you are judged relative to how you do relative to the indexes. So when the indexes are popping, you can't stay out. And so there's kind of a forced entry element that starts to come into play. I think we're getting close to that spot of where that could start to take over. I think we've seen a little bit of it come in. We've seen some very highly differential elements come into play. But that is something to keep an eye on. It's not something that I say, oh, well, hey, you know what, let's just go buy the market based on that thesis. I don't think it's enough, right? I don't think it's enough. But you look at the conundrum that fund managers are going to be in. It could be quite a conundrum. What would kind of leave fund managers in a little better spot? Well, just, a little pullback. A little pullback. Pullback 2-3%. It's not going to ding most fund managers in a big way. And, their relative element will look a little bit better overall. Not for all, but for the majority there. Okay? So it's one of those where, I look at this market. I understand the element of some of the forced buying that can come in. Let's face it, the analyst activity has been almost absurdly bullish to start this year. This rally, whatever you want to call it, this rally would not happen to this degree without the analyst. The analysts have driven things in a way that we don't typically see. And they have been on the bullish side for the majority of things, and strongly so. And we talked about why and what's going on in the fundamentals and how cheap the fundamentals look if the market doesn't, or the economy doesn't go into a recession. Right? Analysts are going to be forced to change their tune if there's a recession. But, we see analysts using this dip in the market, this dip in valuations, to really come out and upgrade things over and over and over. And, when you get a surprise like GM this morning, where GM comes out and raises their guidance going forward, not just by a little bit, but by a lot of bit, you start to make the analysts look a little bit better. The analysts start to try to find more GMs out there, and I suspect we'll see a little bit more of that here. But anyway. There are still other things, I mentioned this morning, Caterpillar and Goldman Sachs, Goldman trimmed their estimates on CAT a little bit, here overall. So this morning for the challenge, I went to cash. I sold my Pfizer. Pfizer's rallied here a little bit, but, I don't think there's anything all that different here with it. But as I mentioned this morning, I just wasn't comfy with the risk. I just from the moment from near the close of the market yesterday, and I was just happy to be able to get out this morning. And then GLD I sold this morning. It's rallied about another 10-15 cents here. Look, I still like it. I still am very bullish on GLD. I still think this is a really interesting setup for a little bit of a breakout higher here, and I would expect the breakout to be about $1.50. And so pushing it up just from a pure technical measurement standpoint, pushing this up towards 123.5 to 124 is kind of what this little pennant looks like, right? And we have this little kind of pennant forming after, a big move. These tend to mark the middle spots of the rallies. Pennants can always look a little bit different, but they tend to mark the middle spot of rallies. And so to see, that next leg higher is what I would expect to see, based on the chart there. I did put in the stream a little bit from Mark Holbert on gold and his gold sentiment and all of that. And I'll let you make what you want of it. But, I don't make too much of it. In fact, if you go on and read further down in it, he's the first to admit that contrarian analysis it isn't always, effective, right? It's one of those things where contrarian analysis is always pointed to when it works, but most of the time contrarian analysis is not what works in the short run. So, it is something I may look to get back into before the close, but I would do it with if I do it, I will do it with a different option. We've seen it push back above the 7-hour moving average, here a little bit, but, I don't think there's a lot of risk of it going anywhere here today. Really making a sizable move here today. And as I look at this market open, and as I look at where the market is today and what's moving and what's not, I don't see a huge risk of a big move in the market today. It's one of those where, if you're looking for the market to have some sort of, real change element to it, right, where it's going to break down. Let's just say you're waiting for that next shoe to drop, right? Take a look at the average true range on the market. The average true range is 5.5. I mean, that's saying that the average range on the market any day is 55 points, right? And you can imagine what's going to happen to this average true range with a few more days like today, right? Where the range here on the day is what? The high 258.27, the low 257.03. So it's 1.2, right? 1.2 is the range so far versus the average range of 5.5. That's just a massive drop. What has to happen to options? They compress dramatically. We're seeing that. And, if you look and you say, okay, what do we have to see to say, hey, you know what? This market, another shoe is ready to drop. Well, you can even come into the hourly with the SPY and look at the hourly ATR here of about 15 points, right? 1.5 on the SPY. And you can say, look, if the market moves 15 points in an hour, that's probably an indication that something's going on, something's happening, something's changing. Until that, you're probably not looking at it. You're probably looking at just the oscillation of things. And we've seen that here this morning, with some of the up and some of the down here this morning, just kind of that oscillation, nothing really driving it, right? Nothing really, you can't look, here's a minute chart of the market, you can't look at this move and go, ooh, what happened, right? Or this drop and go, ooh, what happened? Or even the move into the close yesterday and go, ooh, what happened? What is this bullish? Is this bear? It's not moving outside of ranges that matter. At least so far, and eventually it will. Here overall. Now for the challenge, as I mentioned, I went to cash. I've priced out Twilio a couple times here today. I've decided not to jump in yet. And, this is one where the options aren't cheap, and, for good reason. But nice little consolidation pattern, nice little breakout element happening here today. But I'd like to kind of give it just a little bit because this is a company, this is a stock, these types of stocks, they're known to have some of these little breakouts and then reversals. We saw it right back here where, nice little bullish breakout of a little bit of a consolidation, reversed on with the market. And, I think that risk is there. If the market was in a little bit of a different spot, maybe I'd be willing to take it, right away. But, the risk reward sets up pretty interesting for the kind of the 96 level. So have my eyes on that here today, and we'll be looking for an entry. We'll be looking for an entry there as the day progresses, but probably not until a little later in the day, just given the fact that the market just looks like it wants to chill out a little bit today. You can take a look at Bank of America. 3 side-by-side candles, right? What's a side-by-side candle? Well, side-by-sides happen. Generally, you'll see a bullish run, okay? And then you'll get this, you'll get this kind of just small bullish Marubozu candle where it opens on the low and closes near the high, and nothing, too descriptive about it. Then the next day, stock will gap down towards the low from that prior day, and then rally back towards the high of that prior day. And this is referred to as side-by-side action, and it's generally very bullish in its implications. We don't see it very often. It's not super common to see out there, but its accuracy is pretty good. Its probability in terms of what goes on going forward is pretty good. What's even more unusual is to see kind of a triple side by side, which is kind of what we have here with Bank of America right now. We have a little triple side-by-side action going on, and I would not be surprised to see, Bank of America with a little bit of pop ahead of their earnings here next week. I've taken a look at the call options. They are playable. For that, and if Bank of America ends like this here today, I may grab a little bit going into the weekend, here with Bank of America. But that's one that I'm watching along with Twilio, and then very interested in how some of these industrials kind of hold up today. They're going to have these, it looks like they're going to have some of these little inside days. Overall, these have been emblematic of short-term tops. When we've seen short-term tops in a lot of these stocks, we've seen this type of action, like we see in CAT, like we see in Deere. So, my eyes are on that, kind of watching some of that, the Honeywells here of the world. And, just haven't pulled the trigger here just yet. I don't have a lot where I go, oh, okay, there's a trend signal or something of that nature coming in where we have, big, bad, bearish breakdown. If we just look at the bullet or the bearish gaps here today, stocks that gap below the 7-day moving average today. Let me just alter this a touch here so we get the right thing. There we go. You can see they're 155, but this is looking at all U.S. stocks. If we look at some of the big names, stocks that gap below the 7 today, AMD, Activision, and several in that sector, including GameStop. I looked at for puts yesterday. There was a piece of news that came out talking about Amazon and Microsoft kind of teaming together to put together a streaming console type of service. And, that's going to have a little bit of a negative impact on a GameStop, but the spreads were just absolutely horrific. But interesting to see ATVI on there. We see a few banks, Starbucks, which, caught some negative analyst action today, Target, but, Lululemon. But you can see a few of these here on this list, with some gaps down below the 7 here today. Quite a few, but most of them, they're not seeing sell action. So they've gapped below the 7, but they're not really seeing any real sell action, come into them here just yet. I'm going to step away from the market here for about an hour, and then I'll be back. I'll take a look at things, take a look at where things are and how things are set up. And I don't want to go into the weekend in cash. I may have to, but, that's not what I want. And we'll be looking at, the different setups that we talked about as well as a few others. And hopefully we can get some cash into play and, have a good, good start to early next week and, carry that on forward. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.